Hi, everyone. Thanks for joining. We're going to give it a few more minutes just to allow for some more people to get on, but we'll be starting soon. So thank you. Just going to give it another minute or two. All right, so I guess we'll get started. So thank you to everyone for joining us today. The slide deck will be found in the handout section on your webinar toolbar. Please use the questions section on the right-hand side to ask questions throughout the presentation. We'll be holding all questions for the end. We understand that we may not be able to cover all the questions during the Q&A section, so please be patient. And we are also going to be sharing the slides and the presentation video recording link following the live presentation. So. Welcome to 2020 year-end tax planning for law firms and attorneys. Again, our housekeeping will be recorded, 50-minute session, questionnaire at the end. And just a little disclaimer here. This content is for general information purposes and only should be used and should not be used as a substitute for individualized tax advice with the qualified tax advisor. This content represents the views of the authors only and does not necessarily represent the views or professional advice of Withum, Smith & Brown. So I'd like to take a moment to introduce our presenters. Here with us today, we have Dan Mayo, who's the national lead of our federal tax policy team here at Withum. We also have Scott Paterson, a senior manager with our professional services team. He's part of our law firm's team as well. And Ed Sadowski, who's a principal with our professional services team, also part of our law firm's team. So thank you to our presenters, and we're going to get started. So.
Great, thank you very much. So we're going to start today with talking about the political landscape. I'll be quick on that since we've had some developments that have sort of firmed things up. But on the next slide, please, we see that. There we go, thank you. These slides were prepared about a week ago and they were submitted, so they're a little bit out of date, as you can see. But Joe Biden has been unofficially declared the winner. He's now our president-elect. He has 306 electoral votes now, which is exactly what Trump had 4 years ago when he beat Hillary Clinton. President Trump is pursuing lawsuits in many states. Many have been dismissed and/or have been dropped. And so it looks like the election is going to be the unofficial results will be official at some point in the near future, although President Trump hasn't conceded yet. But we had record voter turnout this year for both candidates. Biden received over, I think, 76 million votes now. And I think he had around 5 to 6 million more than President Trump. As the Senate stands, there was no blue wave as the media had been predicting, so the polling didn't materialize. It didn't turn out to be as well as they had thought. As it stands now, it's 50 to 48. The Republicans have so far have control in the sense that they have more votes, but there's two more seats are up for a runoff election in Georgia on January 5th. And so the Democrats really need to win these 2 seats in order to gain control of the Senate. Otherwise, we'll have a divided government, which we'll talk about in a moment, which is either good or bad depending on your political affiliation. There are 2 seats, Georgia's races, Senate races, 2 seats were up or close. They're going to a runoff on January 5th. Of course, Georgia is a historically Republican state, so the edge and lead is certainly with the Republicans, but they are likely to retain control of the Senate. But if the Democrats do win these 2 seats, it'll go to 50-50, which is a tie, and Vice President-elect Harris would get the tie vote, which would give the Democrats control of the Senate. But that's their only path at this point for the Democrats to have control of the Senate. They do control the House, although with a slimmer majority than they had before the election. So we're going to have a divided Congress and Democratic president and vice president. Next slide, please. So there were many possibilities before the elections. I've sort of grayed out 3 and left the one that looks like we're going to have the most likely one, which is Biden wins the election, Democrats control the House, but not the Senate. That seems to be the most likely scenario based on where we are today. So there's going to be a split Congress, which means Biden will not be able to enact the more progressive policy items of his party, healthcare, climate change, certainly higher taxes in the main. This is generally thought to be a center-left Biden presidency. The party certainly has shifted dramatically since Obama was in office. It's thought to be one of the most progressive in history. But Biden has traditionally been a moderate, which is why it's generally referred to as a center-left presidency. Because you will not have control of Congress, you're likely to see more executive orders and federal regulations. So governing through executive order and regulation, which is similar to what President Trump does today, because the Republicans have the Senate and the presidency, but not the House. In the event that the Democrats do win the Senate, they win those 2 seats up on January 5th in Georgia. They have the tie-breaking vote with Vice President-elect Kamala Harris. We would be in that left column there, where you're likely to see a very progressive agenda come out of the administration and Congress. Again, perhaps one of the most progressive in history. The party has shifted to the left in the last 4 years, as we all know from watching the media coverage. And so in that case, we're likely to see the larger, more tax increases. So we're going to focus on a split Congress at this point, given that's the most likely scenario. If the Democrats do win the Senate, we're likely to see some of the more significant tax increases we're going to talk about on the coming slides. So turn to the next slide, please. So now we're going to go to the next slide. Again, we'll talk about some of Biden's tax proposals. I do want to caution everybody that there is no one document where then Vice President Biden laid out his tax proposals. And so these proposals have been pulled from a variety of sources, including campaign statements. And you're going to see a lot of ambiguity in these, and they're very vague, these proposals. Some would say that that's done on purpose, that the vaguer the proposal, the less of a target that's put on it, and makes it harder to attack by the Republicans. So, but one thing that's clear is, so it's sort of a theme to many of these things, is that Biden said he would not tax the middle class. He would raise taxes on the wealthy, but not on the middle class. So we're going to see the first 3 proposals only hit taxpayers who make more than $400,000 per year. So the first one is he would raise the highest individual tax rate from 37 to 39.6% for taxpayers who make more than $400,000 a year. Recall, this was the tax rate before the Tax Cuts and Jobs Act. President Trump signed that in December of 2017. That lowered thought to be one of the most significant tax reform legislation since 1986. And that one of the things it did was lower the rate from 39.6 to 37. Biden would bring that back, 39.6 for what he calls high income taxpayers over 400,000. He would also phase out that new 199A QBI deduction, again for taxpayers over 400,000. This deduction also again came in 2017 with the Tax Cuts and Jobs Act. Biden would also phase out itemized deductions for taxpayers with income over 400,000. So there would be a phase out. There's a separate proposal, and you see 2 down, which is to cap the benefit of itemized deductions at 28% of value. It's not clear how he would do that, but you can see that if the income is being taxed at 39.6, but the value of your deductions is capped out at 28%, taxes will go up. The interest rate on long-term capital gain, this is really a significant proposal here, this 4th bullet down. Biden would increase the capital gain tax rate from 20%, maximum 20% rate today, to 39.6. And that would apply both to long-term capital gain and to qualified dividend income, which loosely is dividends from U.S. corporations, loosely, as a generalization. But in this rate increase would only apply to taxpayers making more than $1 million in income. So you're really getting rid of the capital gain rate for these people, long-term capital gain rate and QDI rate, and making it equal to the ordinary income tax rates. So this would be a significant departure from current law, and would have a great impact upon the audience here today on this webinar. The last one is also a significant tax increase, would be a significant tax increase if Democrats had control of the Senate, were able to pass it. Obviously, most of these proposals are not likely to be enacted, given that they have divided Congress. And without the Democratic control of the Senate, they're not likely to pass these kinds of tax increases through Mitch McConnell's Senate as it stands. So we have to temper a lot of this discussion of Biden's proposals or what he would do if he had complete control and autonomy with what he's likely to do with limited control and autonomy, given that the Democrats only control the House, not the Senate. But what he would do here on the employment tax side is subject wages in excess of 400,000 to the Social Security portion of FICA, and also the employer portion would apply too. So it's really 12.4%. But it's not clear whether he would also tax wages between the gap here, the donut hole between 137.7, which is the current limit for this employment tax. It caps out presently at 137,700. So between that amount and 400,000, it's not clear if that would be subject to the 6.2% Social Security tax. When you look at in terms of revenue raisers, the individual tax raises by far the bulk of the revenue for the federal government. The next biggest item are employment taxes, which is why this is so significant. Last I looked was around 2018 stats, were the latest I saw. And you had, I think, something like 1.8 or 1.9 trillion from the individual income tax, and you had, I think it was something like 0.6 for the employment taxes. The corporate tax was much below that at 0.3. So the individual income tax raises around about 6 times as much money for the federal government as the corporate income tax. So when it's not if the government's trying to raise revenue, increasing the corporate tax rate is not going to do it, given it's a much smaller piece of the federal pie. Next slide, please. I'm switching now to the corporate tax proposals that have come out of Biden's campaign. The headline here is that he would increase the maximum corporate tax rate from 21% to 28%. This seems like a big jump. Historically, it's still a low rate, would be a low rate for corporate taxes. Recall that before the Tax Cuts and Jobs Act, there was a graduated corporate tax rate from 0 obviously to 35% was the highest rate, and I think it hit that around the $10 million mark. There is now a flat tax after 2017 of 21%. That would increase to 28%. Biden would also tighten the opportunity zone regime. We think it's not clear how he would do it, but probably by limiting the types of businesses with the goal of encouraging affordable housing and job creation. So trying to get more businesses rather than pure real estate plays into the opportunity zone regimes. So low-income housing and businesses that are creating jobs would be favored investments to go into the opportunity zones. Recall that the opportunity zones have a triple benefit for taxpayers. So if somebody recognizes capital gain, They are able to reinvest that gain in an opportunity zone through what's called a QOF, a Qualified Opportunity Fund. And the three benefits are: one is deferral. They get to defer that existing gain they recognize today until 2026, the end of 2026. Two is they get to eliminate 10% of that gain if they hold for the opportunity zone investment for at least 5 years, which you'd be able to meet that. There was a way to eliminate 15% of the gain with a 7-year holding period, but that opportunity is no longer available, given that you need to meet the 7-year period before the end of 2026. So the opportunity for that extra 5 piece of elimination is no longer available. And the third and the most significant benefit from the opportunity zone regime is that the all gain from the investment in the QOF, the Qualified Opportunity Fund, all gain, 100% of the gain is eliminated if the investment is held for 10 years. So that's the triple benefit of the opportunity zone regime. Biden also would repeal the 1031 like-kind exchange rules. These rules, but possibly only for taxpayers making more than $400,000 a year. These rules were limited as part of the 2017 tax reform. They had applied to a broad range of property, investment property. As it stands today, 1031 rules apply only to real estate. So he would repeal these rules, which would have a significant effect on the real estate industry. He would also limit investors' ability to use real estate losses, possibly only for taxpayers, again, over $400,000. Now, it's not clear how he would do this. He might, tinker with the passive activity loss rules, appreciation into the loss limitation rules. I think another impetus here might be what comes out of the eventual review of President Trump's tax returns. We've seen the article in the New York Times, everyone I'm sure has seen that by now, where they reviewed, I think, 20 years of his tax returns and pointed out the many ways in which he was able to reduce taxes for many of the years to zero, some for 2 of the years to $750, not thousand or not 750,000, but literally $750. So not commenting on the accuracy of that article or whether the losses were appropriate, but I think that there's likely to be some backlash from that if those returns are made public at some point, which could further increase Democratic desire to have real estate tax reform. Also, some offshoring penalties. He would, for businesses that offshore their business and then sell the items back in the U.S. But the next one is really the biggest headline one. The next two on the international tax side. There would be a new minimum tax of 15% on global book income for larger companies. It wouldn't affect the law firm so much, but certainly the client base. That also would increase the GILTI tax. It would double the GILTI tax rate, mostly by eliminating what's called the FDII, the foreign-derived intangible income deduction, and by limiting it to a country-by-country basis. So the GILTI tax rate would double. Next slide, please. We turn now to the estate and gift side. Here we're likely to see, again, if Biden had his way in control of the Senate, there would be significant reform. It's not likely to happen with Senate control, but what he would do, I'll sort of discuss it briefly. He would get rid of the step up in basis on death, which is huge, right? As it stands today, if there's unrealized capital gain at death, it disappears, subject only to the estate tax, but the capital gain would disappear. He would eliminate that at death. It's not clear how he would do that. So if he requires taxation at death, that could require some estates to break up businesses or sell real estate in order to pay the tax. So it might just be that there's a carryover basis. You don't get that step up in basis. It would be a carryover basis. So when the asset was sold, the gain would be realized by the heirs and the recipient of the property after the decedent passed away. The next big one is reducing this lifetime exemption amount. It's currently $11.58 million in 2020. Married couples can double that and take advantage of over 23 million, 23.16 million. This rate is a lifetime exemption, applies to the gift tax. So you can gift during your lifetime, you can use this exemption up. It is scheduled to go down to 5 million at the end of 2026, I believe, or it would be in 2026, I should say. That was the rate prior to the Tax Cuts and Jobs Act. The Democrats would allow that to sunset, certainly would not, reinstate it, bring it back up to 11.5 million, and likely would reduce it further to 3.5 million. The IRS has stated, though, there would not be a clawback. So this is leading to a tremendous opportunity. if you think this is going to disappear, you can use it up this year and it won't be clawed back. So it's an opportunity for significant passage of wealth from one generation to the next by using this large, the largest lifetime exemption that's been in existence. And if it's reduced, it'll be gone. You won't be able to bring it back. But if you use it today, there's no clawback. Also, there's proposals to limit the valuation discounts like DLOMs, DLOCs, discounts for lack of marketability, discounts for lack of control. Might be limits on their ability to use them for gift tax purposes. So we go to the next slide. So the next two slides. The next one, I think, yeah. Polling question 1.
So we have a polling question right now I'm going to launch. So has the 2020 election affected your 2021 personal or business plans? So let me just launch that real quick. All right, we're seeing some votes come in.
All right, we're skewing toward the yes, but it's dropping quickly as the more votes are coming in.
Yeah, we have about 67% voting, so I'll give it another few seconds to get yours in.
This might be like election night where we had looked like a Republican victory until the late votes came in.
All right, I'm going to close the poll. So.
All right, so 55% of you said yes and 45% said no, as close to what we'd expect. Let's go to the next slide, please.
Okay. All right.
And we'll move again one more. So now we're going to talk about some general year-end planning ideas. Then we'll go to some election-specific. The general rules to defer income and accelerate expenses, right? $1 paid today costs more than $1 paid next year, $1 of tax. You'd rather defer the tax because the time value of money reduces it, right? Which is why $1 today costs more than $1 spent tomorrow. So how do we defer income and accelerate expenses? The first thing on the deferring income side are like-kind exchanges of real estate, so what to defer paying the tax. We talked about that briefly before. Investing capital gain in opportunity zones. That's again that triple benefit we talked about, which is recognized capital gain. It can be invested in opportunity zones. There was an extension of the time period in which to invest some of the gain to the end of this year. So depending on when you realize capital gain in 2020, there may still be an opportunity to invest in an opportunity zone, even if the 180-day period has technically expired. Rollers of qualified small business stock gain is another opportunity. So Section 1202 eliminates gain on the sale of qualified small business stock if it's held for more than 5 years unhedged. There's a bunch of requirements in there, but this is a tremendous benefit to eliminate 100% of gain. There's also, you can do rollovers under Section 1045. And so if you don't meet that 5-year holding period, you can roll over the gain from qualified small business stock into a new investment in qualified small business stock, defer that gain, and then hope to, again, take advantage of 1202 through the passage of more time till you gain a 5-year holding period. But even without using 1202 in the future, 1045 operates independently to defer that gain on the sale of qualified small business stock as long as it's reinvested within a 60-day period. Installment sales, if you're selling a business, just take a note back and have some payments made in the future, and that will allow for gain to be deferred until payments are received under the installment sale. And finally, contributions to a health savings account. Assuming you have a high deductible health plan, you get triple benefit by investing in a health savings account. Get a deduction today. Income is earned tax-free over time, and then tax-free use of the money as long as they're used for qualified healthcare expenses. Next slide, please. So again, year-end planning, we talked about deferring income. How do we accelerate some expenses? I should mention too that these are not, we're condensing a lot of these ideas for purposes of the webinar here. On the Withum website, we have a more comprehensive year-end planning guide. I think it's 40 pages or so. It's getting to be a long document, but it has a more extensive list of year-end tax planning ideas, and also it has a lot of industry-specific ideas. So if you have clients in a particular industry, we have industry-specific content. So this is all up on the Withum website. Sorry for the shameless plug there, but it is all there. And you know, these slides represent a small portion of the tremendous amount of ideas that are on that larger document. So how do we accelerate expenses? You want to bunch them up is the way to do it, right? Because most people take the standard deduction these days, since it was increased so much as a result of the 2017 tax reform. In 2020, the standard deduction for an individual is $12,400, $24,800 for married filing jointly. So the key here is to bunch up the expenses, so to bunch them up so that the itemized deductions exceed the standard deduction, and then the taxpayer can itemize and get the benefit of the additional deductions. So how do you do that? One is to date and mail checks in 2020, so you get the deduction this year as opposed to next year. You can also make deductions like charitable, for example, on a credit card, so that you're entitled to take the deduction even though you don't pay it until 2021, as long as you incur the obligation with third-party debt, like with a credit card, in 2020. You can contribute money to a donor advised fund, which allows you to gift the cash today for a charitable contribution, and then allocate the funds in later years. So you give, say, $5,000 today, and you could allocate $1,000 a year for each of the 5 following years to charities of your choice. You can accelerate medical expenses. Recall there's a 10% floor. You have to exceed 10% of your AGI, your adjusted gross income, for medical expenses to be deductible. Obviously, we're not suggesting you incur surgical procedures you don't need or medical expenses, but if you need a procedure, you can and have the ability to accelerate it into 2020. That might make sense to again, to bunch your deductions in a single year, so you can exceed the standard deduction. Similarly, paying some of your mortgage interest, your January 2021 interest in 2020, or some of your estimated state tax payments, you pay them early. Remember, though, there's a $10,000 SALT deduction limitation that came in. So you know, this affects the high tax states like California, New York, New Jersey, as well as some others, but certainly has a big impact there. So you are going to be capped out at $10,000. The IRS recently, about a week or two ago, did bless one of the workarounds, the pass-through income tax workarounds. And New Jersey has the BAIT, for example. And the New Jersey BAIT is a way that you take a pass-through entity like a S Corp or a partnership. You can trigger the tax at the corporate or partnership level. It flows through the individual, and it's not subject to this 10K limitation. So there are that workaround has been blessed by the IRS. It's available, but you have to make the payment by the year end. So the partnership, for example, would have to make the cash payment by the end of by December 31st in order for the deduction to be deductible by the individual in 2020. Again, making a full year contribution to a health savings account, another way to do it. With the compensation side, you know, the incentives are different with a C Corp and an S Corp. If you have an S Corp, the incentive generally on the owners of the S Corp who work for the company are to reduce the salary paid to the owners, but to increase the distributions of profit. So the goal here is to reduce the employment taxes that apply to the salary, but not to the profit. When you get into the C Corp world, which is your typical corporation, the planning here involves reducing the double tax, not the employment taxes. So you're willing to say the goal is to increase the salary of the owners of the C Corp, again, in the small C Corp setting. By increasing the salary, you eliminate that double tax. Granted, you have the employment taxes, but that's a small price to pay relative to the double tax of the income inside the C corporation. So different incentives depending on whether you have a C or an S Corp. Next slide, please. We'll talk about some election year planning. So on the election year planning, again, it's hard really to give definitive advice on what to do. The best we can say is if you had a Democrat, you know, a Democratic sweep, and if you get a Democratic sweep in January, we'll know the outcome of the Senate January 5th. If you had that, most people would be pretty confident that rates were going up somewhat significantly. Biden's total tax increases they put a number of about 2.4 trillion on the total amount of taxes he proposed to increase. Now, granted that you don't normally see the candidates' proposals come to fruition as they're proposed, but certainly a large amount of tax increases. Without control of the Senate, it's not likely that any tax increases will go through. There will be some here and there for, like, the family credits, that kind of thing. That some of the credits that tax increases that Republicans can get behind, since the Democrats will need Republican support in the Senate. But if you did think taxes were going to go up, and if you still do, you would want to do the opposite of what we were saying before. You'd want to accelerate your business deductions and accelerate income to subject to the tax today before the rates go up next year. And so some of the ways to do that, you elect out of bonus depreciation. So by eliminating your deductions, you increase your taxable income. You could trigger gains now instead of later. You can trigger them in 2020. But what we really tell people here is, think of accelerating something you would otherwise do. You don't want to do something uneconomic or something that's not consistent with your business. And you don't want the tax tail to wag the planning dog, right? The tail shouldn't be wagging the dog. The dog should be wagging the tail. So think in terms of business necessity. What were you thinking of doing? Maybe you can accelerate something subjected to tax today before rates go up. Similarly, on the personal income side, you might trigger long-term capital gain this year rather than next. Many ways to do that. You have actual sales. You can do constructive sales under Section 1259. One example is a short against the box. Remember here that the wash sale rules do apply. So if you recognize a loss, purchase the stock back, you don't have the ability to take the loss. So you just want to highlight that as another thing to think about with year-end, securities planning. To recognize income, IRA conversions, like a Roth conversion, is a way to convert a pre-tax retirement account to an after-tax retirement account. Taking a required minimum distribution, even though it's not required in 2020 as a result of the CARES Act, or possibly exercising a stock option, or making an 83B election. So these are things you can do to accelerate income if you think rates are going to increase next year. Turn to the next slide, please. So with that, I'll turn it over to Scott to cover the taxation of PPP loans.
Thanks, Dan. Can we start the next slide, please? So we're going to switch gears now, going forward a little bit from Dan's planning and election-related focus, and talk a little more about the tax update. Ed and I will talk a little bit more about the tax updates that have happened recently, to give more background there. And one of the hottest topics we're hearing now is, or we're getting, biggest questions we're getting is related to the how the receipt of PPP loan funds would be treated for tax purposes. And for the most part, unless you intend to or have already applied for forgiveness, the receipt of a loan follows the general loan rules, that there's no tax consequences upon the receipt of a loan proceeds because there's been no accession to wealth because of the obligation to repay the loan. This general rule still applies. Next slide, please. When it becomes to forgiveness, though, normally when you're forgiven a loan, when you have a loan forgiven, it gives rise to cancellation of debt income because you have had an accession to wealth this time, because you no longer have that obligation to pay the loan. You receive the loan proceeds, so you have become richer by the amount of loan you no longer have to pay. The CARES Act actually specifically carved out the forgiveness of the PPP loans as a non-taxable event. So there'd be no cancellation of debt, or no taxable cancellation of debt income upon the forgiveness of a PPP loan. That was all the law said. There's been no discussion whatsoever beyond that. The forgiveness is not cancellation of debt income. The IRS, on the other hand, next slide, please. The IRS came to, stepped in and essentially said, well, we understand that these proceeds, they issued guidance to cover the intended tax treatment in the view of the IRS, and what they had came up as the expenses that are otherwise normally deductible, meaning your payroll costs, rent, utilities, et cetera, that were permissible for PPP loan use purposes, are allowable deductions to the extent being limited by Code Section 265, and the Code Section 265 and regulations thereunder for the most part, state that as long as if income is otherwise, a deductible expense is otherwise allocable to a item of tax exempt income, such a deduction would also not be tax deductible. And as the CARES Act made clear, the receipt of the PPP loan being non-taxable income, the deductions that were paid for with such PPP loans would not be eligible as tax deductible expenses. The net effect of this really is that you have 6 of one or half a dozen of the other. If you either have cancellation of debt income or you have disallowed deductions, you still have a taxable income. There is proposals in Congress that have been proposed to correct, we'll call it correct, or to implement the congressional intent that this is not going to be taxable. It would not be a treatment of an increase in income to the recipient of the PPP loan or forgiveness. Let's go to the next slide. We'll cover a quick example of how this, to illustrate how this applies and how this really works out. Because on the first case, you have the base case, is what you have no PPP loan and no limited deductions. So you have $500 of income, for example, and $300 of expenses. You have a net income of $200. If the loan of $100 was taken and forgiven under a normal non-CARES Act treatment, the loan would be treated as $100 of COD income. You would have essentially an increase in income from $200 to $300. Now, on the last column, the IRS's view is that you have $500 of income, $300 of expenses, $100 of disallowed expenses for a net $200 of expenses, and your net income is $300, which is exactly the same as if you taxed the receipt of the PPP loan. So we're waiting for clarification on whether the congressional intent, well, what we perceive as the congressional intent will be fixed, or if the IRS either updates its guidance or if there is a legislative correction to not disallow the deductions to get what was effectively the third column under the assumption that the PPP loan was intended to make everyone whole in the first place. So in theory, you should be column 1 and column 3 should be the intended result. Next slide, please. One thing that is not covered here is the timing of the deductions. And there's all sorts of internet opinions of when you are going to pick up the loan forgiveness into your income statements. The IRS has already, they've at least indicated they expect to issue guidance by the end of the year. And potentially by the end of this month, clarifying the timing of the deductions. But in the view of the guidance we've already seen, and with our discussions with the IRS on this issue, their position has been made clear that so long as you anticipate your forgiveness of the PPP loan, expenses that were related to that loan are deductible in the year that they were incurred, not the year of forgiveness. So for example, if you had a PPP loan that you took out in 2019 and you applied for forgiveness in November and you received forgiveness in January of 2021, the IRS's position that you have to disallow the deductions in 2020 and not 2021. Again, we expect this guidance to become clear over the next month or so, and there shouldn't be an issue there. And again, there might be additional clarification going forward for either through Congress or additional changes to the IRS's opinion in the notice they issued. So at the end of the year, the considerations that really should be the companies really should take into account is that, again, like Dan had said, accelerating deductions is a potential planning opportunity to reduce your the impact of the PPP forgiveness. So you can either pay extra bonuses, accelerate other expenses you would have otherwise incurred. The extra bonuses may not be already expected expenses, but they might be additional expenses to kind of share the wealth, I'll call it. But beyond trying to lessen the impact of the tax, one of the things that, from our experience, a lot of law firms have to grapple with every year is how do you divide the pie for each partner? And the question becomes, does this PPP treat it as an extraordinary item that's shared in a different percentage to the normal generation bonuses that the attorneys would normally have, or is it done in ownership percentages or some other equal sharing percentage? Or is it related to billable hours, that because it relates to your staff billable or utilization? And so the questions have to be decided, and how do you allocate this extra income essentially for the PPP loan, which really is an unusual item. And again, it might be worthwhile putting tax returns that otherwise would be filed on time in March 15th or April 15th on extension to either wait for additional guidance from the IRS or potential correction of Congress. It's not unheard of for Congress to retroactively fix these laws after you would have otherwise filed the return. I mean, last year was a prime example of this, where the CARES Act changed the accelerated our depreciation class lives for qualified improvement property, and after we've already filed returns, and we have to either amend or do accounting method changes on a going forward basis. Next slide, please.
Okay, so polling question. Yep. Sorry, polling question number 2. Did your business apply for PPP loan forgiveness? Give it a few more, maybe 30 more seconds. Looks like we're seeing a lot of yeses come in.
And that's actually what we've been hearing across the board here, is that most clients have either submitted or intended to submit forgiveness applications at this time.
Okay. All right, I'm going to close the poll. And we have 42 yes, 32% no, but I plan to, 13% I did not take a PPP loan, and 10% not sure.
Generally, our opinion as a firm is that we are suggesting all of our clients to apply for forgiveness. We do think that the tax impact of it far outweighs the actual outlay of the cash. So again, give us a call if you have any other questions on that, but we can certainly help determine whether it makes sense. Next two slides, please. So I do want to give Ed a little bit chance to talk. So I'm going to skip this first one. Could we go to the next one, please? So I'm sorry, next one more. The first 2 slides covered the state's initial attempt to get around the $10,000 limit for state and local tax deduction by using charitable contributions. That was effectively shut down almost immediately. Now the states have went back to the drawing board and came back with essentially what is now the pass-through entity tax deductions at the various state levels. Dan already mentioned this discussion about the New Jersey BAIT. We'll focus mostly on New Jersey BAIT here, being a New Jersey-based firm, but analysis largely applies to other states. But essentially, these new laws are the state's attempt to create a taxable deduction at the entity level to create a federal deduction as a business tax, pass that through to the partners and allow them to take a credit there. And so it is a pretty simple approach, and several states have adopted this so far that we know of. At least Connecticut, Louisiana, Maryland, New Jersey, Oklahoma, Rhode Island, and Wisconsin have adopted some version of these state pass-through taxes. They're different. What makes some of these unique, though, like New Jersey and Maryland, next slide please, is that they are elective by nature. So focusing mostly on New Jersey as an illustration, New Jersey BAIT is a elective entity level tax on pass-through entities. It is a tax at the business that the company makes an annual election every year to determine whether they want to apply to this. Connecticut, the Connecticut alternatively is a mandatory tax. But essentially with New Jersey, you can elect to be taxed at the entity level. The entity pays a tax, similar, not dissimilar to non-resident withholding. That tax passes through to the owners as a credit for their taxes, which they would then pick up on their individual tax return. Next slide, please. The reason why we talk about this now for year-end planning is that the New Jersey BATE election is, again, voluntary, and to be able to make sure you get the deduction in time, the payments have to be made by the end of the year. So to be able to make the election, either you have to have consent of all members or an officer, manager, or other member who has the authority to make the election. The election has to be made on or before the original due date of the filing 15 or March 15th of the calendar year to be valid. You can't make a retroactive election to be part of this. And again, it's an annual election. New Jersey has published some minimal guidance, but has not actually given us any sort of understanding where or how to make the election at this point. So we do have questions remaining about what happens if you are filing an extended return for New Jersey, and whether the extension itself it qualifies as an election, or there's some sort of extra outside electronic election that needs to be made. Again, we're waiting for guidance on New Jersey. They've been particularly unclear so far. But we will continue to update. Next slide, please. Again, next slide, we covered this one. Again, I apologize for going through so quickly. We'll cover the next poll question, but I want to give Ed a couple minutes to talk.
So the poll is up. Will you elect into a state pass-through entity tax like NJ BATE? Okay, a few more seconds to get your vote in. All right, so I'm gonna close the poll here in a second. Okay, so what we're seeing is 13% yes, 20% no, and 67% not sure.
Well, so I suspect the no's are basically are mostly firms that are not New Jersey based, I hope, or have significant, or they could be the C corporation return or C corporation entities, but also they could be returns that don't get the benefit. And we're going to cover the risks at the end of this one. Can we go to the next slide, please? So I'm not going to go through a detailed calc here. I have an example in the slides for review, but we're just going to cover the tax rates here to kind of show how they interface with New Jersey's individual income tax rates. So these are based on the collective tax of the entity, not the tax of each partner's share. So for example, it's not $5 million per partner are taxed at 10.9%. It's $5 million of the entity are taxed at 10.9%. Meaning, if you have 10 partners with $500,000 share, $5 million of income, it would be taxed at the 10.9% rate, or the excess of above $5 million would be 10.9% rate, even though all of the partners would definitely not be in the 10.75% is the top individual tax rate bracket. So there is a chance that you're going to be significantly over withholding for partners if you have more than a handful of partners, because you would be out, for example, if you have 10 or 15 partners and each of them makes $500,000 or more, you'd be withholding them at the highest tax rate of 10.9, but they'd only be subject to individual tax rate at 10.75%, and then they would be looking at a situation with a significant refund coming their way when they file their tax return. And And it doesn't matter if the entity is, if any of the partners are tax exempt entities. I know this is not a relevant discussion for law firms, as I don't believe you can have a tax exempt entity owner of a law firm, but it would apply to clients that may be asking this question. Next slide, please. So to illustrate the example, I did a pretty simple example with a New Jersey law firm with 2 New Jersey resident partners and $2 million total income for the entity, allocated 50-50 to each of them, assuming it's all allocated to New Jersey. Under the New Jersey calculations of $2 million of income, the entity tax would be $154,000 or $77,000 per partner. Next slide, please. Comparing whether to make the bait election versus not making the bait election, the entity, each partner, for example, would have, the first column here is that with the bait election, they would take the deduction for federal purposes and reduce their federal tax by $28,500. Without the bait, you would not get that deduction. It would be lost forever. So for a company that qualifies for the bait tax deduction, it is pretty much a slam dunk, assuming you don't fall into some of the risks that we have. We'll cover later, really quickly at the end of this. But if you are a fully based New Jersey partnership with fully New Jersey partners, it kind of is a slam dunk, and you should be electing into this. And I suspect this analysis is identical for the other elective ones like Maryland. Again, Maryland has not issued any guidance at this point, as far as I understand. And they sound to be a little bit behind even behind New Jersey as far as guidance goes. Next slide, please. So the benefits here is that by allowing this full deduction of the entity tax, you circumvent the $10,000 state tax deduction. Again, this is how we just showed that on $1 million of income allocated to the state, you get a $77,000 deduction where you previously would be capped at $10,000 under the new Tax Cuts and Jobs Act. Again, it's only taxed on New Jersey source income. So if you are a multi-state entity that is operating in multi-states, at least, which a lot of law firms are, you'd only be able to tax it on the New Jersey source, even for New Jersey partners. Next slide. Let's skip 2 slides, please. So I skipped the 2 slides because it's not worth that while right now. But 2 weeks ago, we would have had number 1, the 3 main risks and considerations to talk about. And what we've been talking with clients about is that the 3 reasons why you may or may not be interested in the New Jersey bait tax. But the first one, which we thought was one of the most significant, has since, as of November 9th, been removed. So that we originally thought the IRS could challenge just based on the elective nature of the New Jersey tax, and that there's a corresponding credit coming through. The analysis we thought was going to be similar to the charitable deduction analysis, where you get essentially a quid pro quo analysis, where if you get a deduction with a corresponding credit, that would not be a valid deduction and would be subject to the otherwise limitations that you would have had for the state tax deductions. However, the IRS has come out as of November 9th, and issued a notice that they are going to issue regulations that essentially fully allow these state and local tax deductions at the business level, regardless of whether they're elective or not, and regardless of whether or not a credit is passed out to the owners. Now, some of these state taxes don't pass a credit out, they just don't tax the individual owner on the income itself. But the IRS has issued a very, very tax favorable guidance on this, and essentially fully approved these various state schemes, and we'll probably see a lot more of them. But one of the reasons why the main reason why you may not want to do this, the most significant actually, is that for non-resident partners of these states, you may actually lose your resident credit for taxes paid to other jurisdictions. We have no guidance for a lot of states. Pennsylvania particularly has issued no guidance whatsoever on this topic, but we have had guidance that New York intends to disallow the credit for taxes paid to New Jersey as we stand right now. This could change. So if you're a partnership that operates in that has both New Jersey and New York partners, all of the New York partners would, if you elected into New Jersey bait, the New York partners would lose their credit for taxes paid to New Jersey, and it would end up being a really bad idea. So the benefit would definitely not outweigh the cost for the loss of the deduction. The other downside is there's still a duplicative estimate payment requirement in two regards. One, partners may have already been paying estimated taxes throughout the year, so there may be a significant cash flow crunch to also make the bait taxes to be able to take the deduction and then get a significant refund when they file their individual tax returns in 2021. But besides that, New Jersey has not modified their non-resident withholding rules. So even if you elect into bait and have non-residents, New Jersey is currently forcing you to pay your non-resident withholding and your bait on the same income. So there's a chance you'd be double paying on that. You likely are going to get it back, we expect, but they did not remove that non-resident withholding double payment. Next slide, please. And then this is the notice 2027-75 is the actual IRS notice that allows these deductions to proceed now. And again, it's pretty clear that they're going to issue regulations that allow these deductions as these taxes as a deduction, and that these taxes are specifically not subject to the state and local tax deduction limit for itemized deductions, that $10,000 SALT limit. Again, next slide. We'll move on to Ed to cover some state tax nexus items.
Thank you, Scott. We're a little behind. I think I can probably get through my slides in 5 minutes. So I'm going to start with my first slide. If you, what's the result of so many people in our workforce working remotely from states separately, possibly from where their employer's office is located? If you're a business or an employer, that could affect you in one of a number of ways. One of them is that it could inadvertently create nexus for you and a possible state filing requirement in the state you haven't yet filed in. Next slide. Here's a chart from a recent survey that was done. I thought this was pretty informative because it basically lays out for the whole country how the states responded to the survey. And as you can note here, New Jersey and Pennsylvania and New York City are indicating that if you have telecommuting employees, generally that would create nexus for a company. However, New Jersey and Pennsylvania and Philadelphia have issued waivers for the COVID crisis, and they intend not to seek nexus. However, New York has not. In fact, New York has not really responded affirmatively one way or the other, as far as I can see, on the question at all. So I think that their normal position for New York is that that would create nexus. And so without affirmative responses from the state, we should just assume that if you have telecommuting employees in New York, that it would create a nexus for your company. And one other thing, next slide. One other thing I just want to bring to your attention is that if telecommuting becomes the new normal, we're not really sure how these nexus waivers are going to provide long-term protection. I'm not sure if, I guess it depends on state budgetary restrictions or what the future holds. No one's really sure, but this is something that just needs to be monitored. Next slide. Now, if you do have nexus in a state already, or maybe having remote workers creates nexus for your company and you wind up having a filing requirement in a state, the question becomes, how might this impact your filings from the past? Apportionment, as you may or may not know, is the process that multi-state entities use to divide taxable income among states. So some states use a single sales factor. So what were your sales in that state versus your sales everywhere? You take that percentage times your taxable income and you apportion that to the state to be taxed there. Some states use a more traditional 3-factor apportionment formula, which includes a payroll factor and property and equipment and sales. And then other states use the 3-factor formula and they apply different weights to those factors. Next slide. Now, I think the biggest risk, or could you go back one slide? There you go. I think that just wanted to focus on this slide for a moment. I think that states where they use market-based sourcing, which is you source revenue to a state if the benefit of that service is received within that state. That's how they define market-based sourcing. So if you have states that use market-based sourcing, having telecommuting employees in that state is not going to create an issue for services. Where the issue does come in is where you have states that may use cost to performance or some other similar apportionment methodology for revenue, where you have employees that are doing work in that state, and if a majority of the work is done in that state, then you're supposed to apportion the revenue to that state. And if that happens, you may have new filing requirements in the state where you previously haven't had to worry about that. So, you know, it's worth monitoring or talking to your accountants about, you know, what the status may be when you go to do your 2020 returns in some of the states where you have remote workers, just to make sure you're filing where you need to. Next slide. I also thought it was worth mentioning Philadelphia had recently come out with an announcement indicating that for its business taxes, if you have employees that are working outside of Philadelphia who would otherwise be working in Philadelphia, you have to source that revenue derived from their services to Philadelphia. And New York, New Jersey, and Pennsylvania, I haven't seen anything as of yet released from them about the revenue factor issue. Next slide.
In the name of time, we're actually just going to skip this last polling question, so I'll move on.
Okay. Now, the convenience of employer rule, this is interesting. There's a lot of activity going on in this right now. You may have heard, for instance, that New Hampshire is seeking litigation against Massachusetts because Massachusetts is trying to assert that even if you are working remotely from, say, New Hampshire, but your office or employer is in Massachusetts, they're saying that that revenue needs to be sourced and therefore taxed in Massachusetts. And New York came up with a similar position, and they're indicating that even if you, if your office is in New York and you live in New Jersey, and even if you work remotely the entire year, never step foot in New York, more than likely they're saying that income is going to need to be sourced to New York and therefore taxed in New York. And this convenience of employer rule states that you basically have to meet the requirements that I indicated on the following 6 or 7 slides, which I'm not going to go through, but I'm just going to point out that in order to meet this convenience of employer rule and source your revenue outside the state, you need to meet all those criteria. And it's very difficult, and I don't think a lot of people are going to be able to do that. New Jersey, let's see, New Jersey recently issued some legislation, or they have a hold on, I'm trying to find it here. They have an action where they're trying to challenge New York that people that are residents of New Jersey shouldn't have to source their revenue to New York if they work remotely. So really, the problem is, I guess, New York wants to tax the revenue, and New Jersey residents would get a credit on their return for the taxes paid in New York, but New Jersey's thinking, well, we can get the revenue, and it's hundreds of millions of dollars or more, maybe billions. So New Jersey's thinking about fighting that. Now, most people get a credit for taxes paid in their resident state for taxes paid in other states where they may work. For instance, if you're a New Jersey resident, you would get taxes paid for if you work in New York. But there's some states that don't allow that. So there's some states like Vermont, for instance, where their state statutes indicate that you actually have to physically work in that other state in order to take a credit for taxes paid. So if for some reason you lived in New York and you worked in New York, if you lived in Vermont and worked in New York, but you never stepped foot in New York that whole year, you would have to pay tax the way things stand now on your full wages in New York and in Vermont and get no credit. So it works out to be pretty ugly. So this is just something I wanted to point out to everyone. And you could skip to the slide 58.
And just tell me when to stop.
Oh, yeah, keep going. The remote working. Yeah, next one. Okay. So I'm going to wrap up with just an overview of individual taxation. So I'm getting away from the employer, talk about individuals for a minute, and how telecommuting may affect your taxability in other states. And so when you think about residency in a state, there's two ways that states define residency. One of them is a person's domicile, which is where they consider their permanent home. It's kind of, where you go to church or synagogue, where you vote, where you have your driver's license, those sorts of things. That's your domicile. But other states have what they call a statutory residence, which is where individuals spend a significant amount of time, have a permanent place of abode, and spend a certain number of days. In general, that number is 183 days. So if you are a resident, if your domicile's in New York and you decide you're going to flee to the Jersey Shore for 2020 and you've been here for over 184 days, or another state, and you may wind up having a filing requirement in that state, either as a part-year resident or some other status, but it's something that you need to be aware of. Now, in the next couple of slides, I just indicated what the residency definitions were for New York, New Jersey, and Pennsylvania. So when you get a moment, you could take a look at those and at your leisure. I'm not going to go through them now because we're short on time. And the last slide I'm going to forward over to is the slide 66, Alex, which is the UBT tax. So I just quickly wanted to mention this because I thought it was important that the UBT is a tax on unincorporated businesses, which means mostly flow-through entities. And the way they source revenue for that, there's an opportunity for 2020 because it's really service receipts for the UBT are to a location where the services are performed. So if you have remote workers, if you have a New York office and you have remote workers working in Connecticut and New Jersey or Pennsylvania, and they're performing those services in those states, there's a position where you might be able to allocate that income out away from the UBT and not be taxed at that 4%. So that's my slide. Thanks, Alex.
With that, we can pass it over to Scott.
Yeah, so we're really short on time here, and so I just wanted to address one of the questions about New Jersey bait that came through. And again, I thank you for your time, but one of the questions related to whether the New Jersey bait is related to only 2021 because the election has to be made at the start of the year. And I just want to clarify that the New Jersey bait applies to all tax years starting on or after January 1st, 2020. So the fiscal years that ended in the tax year are not applicable, but it starts with your 2020 calendar year, for example, and the election is actually made by the time the tax return has to be filed, not the beginning of the year, and it's an annual election.
All right, well, thank you, Scott. Thank you, Dan and Ed, our presenters. Thank you, everyone, for joining us today. The PowerPoint presentation and the webinar recording will be emailed to all registrants. Please take a moment to fill out the survey questionnaire. It's especially important to fill out the information if you're requesting New Jersey or Pennsylvania CLE credit for this course. Thank you, everyone, and have a great day.